The Reserve Bank has cut its cash rate from 2.25% to 2%. It's the first time it's cut in 3 months. People had been wondering why it didn't cut between meetings, between its big set of forecasts that it does every 3 months. Those forecasts, the next ones come out on Friday. The reason it didn't cut is it wanted to be certain. It wanted a complete update of what was happening in the economy. It now has that. GDP outlook, if anything, looks lower than it did 3 months ago. You've had, just since the last meeting, commodity prices have fallen further, notwithstanding their rise in the last few days with the iron ore price. The Australian dollar is higher, which is somewhat alarming. It means that whatever prices we get for commodities are not translating into Australian dollars as they might. Employment has been steady at best, and wage growth has been lower. Now, add to that business investment, and the forecasts from businesses themselves reported by the Bureau of Statistics are very worrying about the year ahead. It all adds to pressure to cut. There's no reason not to cut. We have very low inflation and ultra-low wage growth. So the Reserve Bank decided to do it, but there was another factor which came into it. It's credibility. Now, the Reserve has been talking about having a bias to easing, being prepared to ease. But if you don't actually do it, you lose that credibility with the market. Now, it's that credibility which has been exerting some downward pressure on the Australian dollar. If they waited much longer, they felt that pressure would disappear and the Australian dollar would go even higher. So it's a new cash rate, 2%, down from 2.25%. The private banks will move their cash rates. They're already quite low. You can get a discounted loan at the moment for 4.8%. That'll now become 4.55%. The overall headline rate will probably fall to 5.25%. It's a cut of around $48 a month on a $300,000 mortgage. It should help people, and it comes a week before the budget.